Boom. All right, ladies and gentlemen, still waiting on a venture capitalist or trying to get some funding? Here's how real founders got funding without one. Let's get this show started. Here we go.
Shut up and sit down.
Look, a business can give you everything you want in life: prestige, wealth, freedom. It can also take everything away from you. This show is for those who are willing to take that risk. These are the real life stories of entrepreneurs. But before we start, I have one small favor to ask. Please leave a comment. It can be advice, critiques, tips, feedback, or share this with someone because your engagement is the most valuable and most powerful form of social currency. So thank you, and welcome to another episode of Business Bros. All right, Business Bros, he's led a $2 billion fintech revolution that's empowering small businesses to finally get the funding they deserve. From alternative capital strategies to avoiding deadly funding mistakes, he's here to help you fuel smart and scale growth. Please welcome to the show, Mr. Ciaran Burke. All right, my dude, welcome to the show.
Thanks so much. Loving the intro music.
All right, I'm excited to have you here. Let's get this thing started. All right, venture capitalist, getting into the money game. That's kind of one of the hiccups that I think a lot of businesses have when they get started. Take me back to when you got started and how'd you get to the point where you're helping people get money?
Yeah, absolutely. And I think two things. One, people can get really stuck on that VC thing because it can take an ungodly amount of time and you can spend so much time trying to chase that VC check and take your eye off the ball in terms of growing your business. In terms of ourselves, Swoop, we're a bit of a walking case study in terms of tapping into every funding source to kind of get us to where we are as a business. First thing we did was we got a startup loan. It was for £25,000. That kind of got us up and running, and we were able to put that over a 5-year period. So the repayments were relatively low, and we could start to generate revenue against that. From there, we kind of looked at grants, and we were working a lot around technology and banking at the time, and there was an industry competition run by a large kind of number of banks that we went and we won grant funding through that. We then went on to raise the first of our equity rounds. We did a Series A for about $7 million. We've since done about kind of $15 million in equity funding, and we've taken on a further kind of $2 million in debt funding. So we've done the full gamut between grants, equity, and lending, which is essentially what we offer as a business to many other business owners out there.
I think that's the key to having a successful practice in almost any field is actually going through the experience and, in your case, accessing the money in different ways and at different phases in a particular business. You've helped businesses access over $2 billion in funding already. Mm-hmm. What are some of the big mistakes that you see founders make when they're trying to raise capital?
Yeah, I think just not knowing how many options are available to you. I appreciate it. You're a business owner or you're a founder. There's like so many hats that you need to wear. But honestly, sometimes just taking it back and realizing there's lots of options available to you. So don't obsess if that bank manager is continually saying no, or crucially, as you said at the top of the call, don't get obsessed with VCs. Like, it's a low percentage game. There's a minutiae amount of businesses, rightly or wrongly, that are going to get that check. So if you fantasize about that and nothing else, it's very hard for you to progress with your business, get growth into it. And hey, if you get it stuck into your business and get that growing, the more other options become available to you, whether loads of different lending products, other grant products that might be available to you. So you don't always have to obsess over that VC check.
Now, I think the VC chase happens because we watch a lot of Shark Tank and everybody wants to get into the tank and everybody wants to make that deal. But they're always quick to give up equity in that case. These other alternative funding opportunities that you're talking about, I think that's where things kind of shift, right? You're not giving up equity when you're still able to access some of these funds.
Yeah, I think that's so true. And I think I'd imagine if you were to interview a lot of people who've been on Shark Tank down through the years and they've kind of started to grow, mature their business, and they're like, oh, I really didn't think about that big old chunk of control I gave away there. And actually staying in the game and staying in your business and looking at your business in terms of, am I generating revenue through Shopify? Have I got customers that I'm invoicing? Have I got machinery in my business? All of these are like asset-based opportunities that you can get capital from. And it doesn't always have to be your bank. There is so many, like in the US, is the largest alternative finance market in the world. There are so many options available to you. So as you chip away in terms of customer growth, revenue growth, those options only increase. And you are making yourself more and more valuable. So when you do decide to step in the equity ring, you don't necessarily need to always give the keys away and give that control, which ultimately is something that should be super precious to you, because it's your passion, it's your energy, and it's something that you're building. So you really need to think long and hard at who it is, and if you're giving away so much at the beginning stage, that can also kind of hit you harder down the line too.
Yeah, and having access to the capital is a good thing, but I think the flip side of the Shark Tank thing is also the attention that your product or service gets just being on the
For
show
sure.
itself, not even having access to some of these deals. But a business needs to understand that there are different options out there so that they can take advantage of the one that best fits them at the stage of the business that they're in. Because I think early on there's that naivete, that excitement, and you're right, they get excited, a lot of equity goes out the window, and by the time they mature, they're looking back at their rookie mistakes thinking, oh man, I shouldn't have done that. What are some of the most misunderstood aspects of funding for SMEs today?
Yeah, you see a lot of it in the kind of early stages, whereby traditional lending, traditional banks, it's on a cash flow model. You're looking at operating profit, profitability margins, whereas that's not always the case in terms of lending capital. Many alternative finance providers can look at businesses in still not in a profitable state by lending against certain aspects. We see this a lot with businesses in the B2B space, where they're trying to straddle a pipeline, collecting cash, running an equity series in terms of talking to investors, when they're banking potentially blue chip companies that have them on aggressive payment terms of only getting cash in every 90 days. But every one of those payment terms is a funding opportunity. They can get cash advance, so they can close on that cash, cycle the next one. Okay, give up 3-4% of the total value of whatever that contract installment is, but it crucially gets cash in the business, focus on the next deal, build up and build up that cash position. And a lot of businesses aren't aware of that. The other downside I see with SMBs and their cash position is how they decide to spend it. So lots of businesses will have lots of bigger capital expenditure. It could be IT equipment, laptops, could be machinery, vans, in transport and logistics, trucking. All of those items don't need to be bought, all items cash up front. That can all be looked at from a leasing perspective in kind of as equipment finance type structures. So instead of outlaying all of that cash up front, put it over a period of time. So you're only expunging a certain amount each month. So there's more cash in the business to get those growth metrics up, to get you into the next stage. So really think hard about those big capital payments that you're putting out there, and trying not to put it all out in one great lump sum. And the other one is, I would say, final one, and I'll shut up, is the thinking outside the box. You're going to be in a certain state, you're going to be in a certain geography, in a certain sector. Have you tapped into what government grants or local competitions? Are you doing something innovative? Are you taking advantage of your R&D credits? What cash can you get into the business in terms of what your ecosystem says you can and can't do in the environment that you're operating? Just doing that, and we're in such an advantage age now. You literally just need to go ChatGPT, Gemini, Perplexity, whatever your vice is. talk to it, tell it what sector it's in, what stage you're in. It can start to tell you what free or easier access money you can get back into your business, and many business owners just don't take the time out to check that and see what's available to them.
Yeah, and sometimes that funding can get you through the ups and downs of your regular seasonal cycles. Those fundings might open up different contracting opportunities. I mean, cash flow is always crucial in especially in things that are retail, even in service oriented companies. That seasonal money, that downside, those are some rough times. And if you have access to some of these additional capital sources, government capital sources, credits, or whatever, like that cash infusion could make that big difference. When a company is getting ready to either look at VCs or even try to expand capital, there's a certain structure. I want to go with like full, GAAP accounting principles or anything like that, but like there's a certain way that they need to be set up so that they're structured in a way where where they can either sell, not that they need to sell, but essentially sell their business opportunity to a VC. When you talk to companies, are you looking for companies that are at the beginning phases, that have already some of these systems and processes in place? Like who can benefit most from getting these types of fundings?
Yeah, so we will look at businesses across all different stages. I think where Swoop really resonates with businesses when they're in a trading environment, either trading between $100,000 and $20 million. It doesn't matter whether at the start of their business cycle or they're a mature business. The reason I kind of give that kind of trading range is it's often the missing middle when it comes to the banking ecosystem. So maybe 20, 25 years ago, you would have no problem having a really good relationship with your bank manager. You could walk down to your local branch. But all of a sudden, the operating models of most banks are really focused and tailored towards mid-cap and large-cap businesses. So all of a sudden, you have this large swathe of SMBs that don't have a natural place to turn to. And that's the audience that we try and speak to and build our product around, so that no matter what stage of growth you're in, you can plug your numbers in. And to your point, you don't need to be an economist or a trained up accountant. We can work off bank statements, uploading documents, connecting in accountancy data, and do the work on your behalf in terms of pulling that information, giving you an indication of what your credit profile is. So before you go and apply for anything, good or bad, we can give you a really good indication of how banks and lenders will look at you, and then start to show you which products you're eligible for, and not just isolate you to one bank or one product line, but show you if there's lending options, if there's equity option, if there's grants options. So you can have a more considered decision as to which product line is going to be a best fit for you for now. But it's absolutely not requiring you to be a CFO or CFA trained. It's requiring you to kind of give an insight into your business, upload some documents, and letting us and the technology kind of look after it thereafter.
Swoop's kind of coming in and being a nice little counselor there. Let me take all your information in. We're living in an AI world, right? So tell me what your business is about. Give me all your financial docs. Let me sort through this stuff and then give you an idea of option A, option B, option C, option D, and why those things are working for you. Did I get it about right?
That's it. Bang on the money. And then we give some nice little treats afterwards. So when you have done a transaction, we'll give some nuggets back to say, hey, you might have a saving here or there, because what we able to do is kind of benchmark you against other businesses of a certain size. So it might say your energy payments are above norms. You might want to save on your energy bill when a renewal comes up, or your business insurance is kind of above market. It's a soft market, so we expect you can get a reduction on your next kind of business insurance contract. So we'll also try and feed that back in to try and give some nuggets back and potentially reduce the OPEX FX for any kind of interest payments that's increased within the business.
I mean, that sounds like a great starting point for almost any business looking to grow. I know money can be tight and it's a struggle, especially when you're first getting started. The sales are coming in, but you're just paying the overhead. You got to expand, but you can't with the revenue you got right now. It's a great place to get started. Can you walk me through probably one of your favorite case studies where a company came in, probably lost like that, stuck in a loop, trying to get to that next step, and then Swoop kind of helped them get in there and change the game?
Yeah. So I think going back to one of the things I was saying earlier on about this obsession with buying things to kind of truck you along. So we had a kind of a transport logistics business kind of come in. It was around COVID time, so you could see the kind of ecosystem of businesses that were growing were really supporting all the online retailers that were happening. So we were having a huge wave of businesses that were supporting kind of a trucking ecosystem, and saw this business kind of come in, and we could see that they were working across their fleet across different markets, and the way they were approaching it was kind of, you could see the growth was there and was great, and they were growing and they were doing it in multiple markets, which was amazing for the business owner first and foremost. But the model was based on like acquiring one truck after the other. And but they would always kind of see those proof points in it. And so first and foremost, we kind of looked at their model and their financing need and said, well, hold on a second, you've got all of these assets on your balance sheet. First and foremost, we can kind of completely raise against that and release kind of equity out of those vehicles and de-risk it against you, any personal assets, any business. So first of all, we can do that. And because it's against a hard asset, the rate you're getting on that is going to be super low. So we can release cash from that. But hey, instead of you going and purchasing the new ones, why don't we look at a kind of a lease back model? So instead of taking this big chunk of change from your fleet, why don't we, instead of buying one or two, go out and get you 10? And all of a sudden, that completely flipped the switch in terms of what they could do for their business and the volumes that they could already start doing. And because they had drivers in multiple jurisdictions across multiple currencies, we could also see that they were doing a lot of transfers in their bank between interbanks and interpayments, and they were kind of using their US principal bank to do that. So they were encouraging so much FX fees, and so straight away what we could introduce them to was using kind of just initially just a broad FX platform to put all these transfers in between all these different countries and people that they were paying, and ultimately all the interest payments that they took on from leasing the 10 new vans were mitigated against all the FX transactions we were saving with the new FX platform. We then subsequently introduced them to hedging so that they could lock in specific rates between USD and Canadian dollars. So then they had a fixed price schedule on that. And they very quickly grew their numbers with an extra 10 fleet on the road. And they were then able to apply that again. And then there was a 50 place leasing order in the next order with us. But it's just an example of just like rethinking the business model slightly, but having a huge impact on what that founder was then able to do and the growth rates that he was able to capitalize on and ultimately benefit from his company, which is very, very cool to see.
And it's different from like when you go sit with your CPA or you go to your accountant, it's always cut this, don't spend here, don't buy your Starbucks. And I feel like I'm listening to your case study here, and it's like, I'm not telling you not to spend. I'm just saying you should spend it this way, right? Yes. Do it like this.
100%. Like I want you to smash the lights out of it. I want to see you grow unbelievably well. Like, I'm not going to deprive you of a frappuccino or whatever your vice is. I want you to go and like get the biggest fleet that you ever wanted to do. So let's just try and come together with the same mindset to make that a reality.
So let me ask you, you've had case studies like this where you're able to restructure a lot of things and help people really access, oftentimes, sometimes the money they already have and just reuse it in different ways, as well as helping them get money outside in different areas. So how should a founder choose between like bootstrapping their company, borrowing, raising equity? Like what's that criteria you feel like when you're sitting down with a client when they should do one versus the other?
Yeah. Such a great question because it's so specific on so many different scenarios for that business owner or that founder. And I think the most simple way that I always think about this is like get into forecasts. Again, I appreciate people are not hugely going to always be financially literate, but boiling it down to money in, money out. So you've given me three scenarios there: bootstrapping, lending, equity. So bootstrapping, money in, money out. You know what if I'm going along at my own pace. What are my kind of expectations here? So from a forecast perspective, I've got my customer base at the moment. Where can I get new ones? How's this going to look like from revenue? And what does that wash? Does that get me excited? What does that look like? How much work does that going to put me in? I might have a figure that I want to get to. How long is that going to take me to do? Okay, I'm going to answer all those questions. It's going to take me this amount of time. I'm going to get to this figure in this time period, and how much effort in it. Okay, look at the lending scenario now. Okay, there's obviously going to be higher risk here because I'm going to take on some capital. That capital is going to have an associated cost with it. What's the period that's against? So how whatever, like, because some people get fixated about rates, and you always want about the cheapest rate, but you also need to get fixated on the length. People don't always think about the length because the longer you can get that thing to, how can I run my business model is basically how much cash I have to pay on a monthly basis. So from any lending product, really think about two things, the length as well as the price. So really thinking that from a cash in, cash out perspective is okay, so for this loan, it gives me X amount of money, which I'm now going to be able to take a more aggressive approach, probably giving me a more quicker top line upside. Can I support that increased thing? And again, does that get me to a scenario where I feel comfortable with the risk, and does it get me to an outcome? And then finally on the equity position side of things, yes, I've got that immediate upside hit. I don't have the necessarily upside on the cost from a month perspective, but I've given away control. How do I feel about that? How does that impact me? Does it impact my decision making? Does it impact my future? Are we aligned from a motivation perspective? Do we want to sell at the same time? Does the money that I'm getting from an equity point of view, does it require a secondary or tertiary transaction? If it does, ultimately, what's the size of the equity piece that I'm having to give away? So they're the kind of different scenarios that will be playing out, but I always do it with a cash in, cash out scenario, and then kind of putting myself in the shoes of those three scenarios and seeing which one kind of I feel comfortable with and I kind of gravitate towards.
And ultimately, we're going to make the best decision we possibly can at the moment in time. And hindsight is always 2020, and there's always mistakes we're going to make. But I mean, that's a good description. It's much better than saying it depends and then leaving it at that, right? Like that's a good breakdown to kind of put yourself in those different positions. What questions to really ask yourself so you understand the best step forward for what you're doing. Now, what about like funding tips, right? Everybody loves, give me the top three. So I'm going to ask you that one. What are the top three funding tips you'd give in an early stage startup, especially in 2025? What are you looking at? What do you think would be three top funding tips?
Yeah, like I think always being funding ready. So what I mean by that is like always know what's available to you because it gives you so much more dynamism in terms of if you've got opportunities are always going to present to you if you're an entrepreneur because you want to know if you can capitalize on them. So what do I mean about being funding ready? Well, it's knowing what's available to you. Obviously, selfishly, I'm going to say Swoop will give you that answer, but you don't necessarily need to use Swoop. You can use loads of other options. But what you need to be able to have to hand are things like, have you got quick access to bank statements? Have you quick access to your accountancy software? Because you can leverage that data to kind of give you the insight to know what funds are available to me at any given time. The second thing is kind of touched on it earlier on is forecasting. it's a crucial thing about funding in 2025. You can make so much better decisions. We talked through some kind of decision-making methodology there. But if you, as well as obsessing about what's coming in the daily takings, and as business owners, there's nothing we love more than whatever Shopify tool or CRM tool that's pinging you what's happened, like a daily sales. Like, oh, it is proper addictive stuff. But step it out a little bit further. Like, what are you predicting? What are you growing? What are the opportunities? Because that helps you think about funding. Because there's no point in going to a bank or to an investor, and if you don't know how much you want, how would you apply it, what impact it's going to have, then there's no point. So forecasting gets you into that. And then the third thing is kind of aligned to that forecasting. What you all of a sudden is you understand your levers. So again, we talked about, well, most business owners won't come from a finance background, but all of a sudden they'll sound like the biggest economic nerds in the world if they get into their economic or their forecast models, because they'll get obsessed about how much it costs to acquire a customer. They'll get obsessed at how much they can repeat that guy. They'll be obsessed at how much value they can get out of it. They'll be obsessed, and all of a sudden they sound like these complete nerds, but they're doing it because they understand the levers that run their business. So those three things, in terms of being funding ready, getting into forecasting, that then drives number three. All of a sudden, you understand these levers, which make you so much more attractive from a funder's perspective.
And if you do feel like doing the Shark Tank thing, you can step on that stage and Mr. Wonderful can drill you on all your statistics and you'll be perfectly ready to answer every single one of those questions. But hopefully you've learned that you don't have to give up equity, but at that same time, you're prepared. If people want to find out more about Swoop, they want to get started, they're like, look, I'm at the beginning phase. I would love to just, sign up, send you my financial docs, and then you tell me what I need to be looking at. How can they get started with that?
Yeah, pretty simple. Swoopfunding.com. And we would relish chatting and engaging with any business. We've got 270,000 businesses on the platform today, covering US, Canada, UK, Ireland, Australia, and South Africa. So delighted to chat to any business owners on our website at swoopfunding.com.
270,000 businesses have already gone through this process, tried it and tested it out. They're sure you guys got tons of reviews and all that sort of stuff sitting around there.
Yeah, you can check us out, Trustpilot, Google review. I think, as with everything, I think all look pretty good. You'll obviously probably see a few aggrieved, but like that wouldn't be unusual with any business out there. But I think for the most part, we stand by everything that's out there about us.
Early on in the show, I would always use video clips to kind of throw things on here. And I think this one just shows, like, it totally suits your particular episode. Show me the money! Thank you, Tom Cruise. Show all about, ladies and gentlemen, swoopfunding.com, swoopfunding.com. If you're looking to get funding, you don't have to give up equity. You don't have to give up a percentage of your company. Later on in this business life, that control is going to be very important to you, but you can still get the revenue you need to help grow and fund your business. And if you listened on today's episode, maybe even get some advice on how to structure that spending to take advantage of your cash flow as best as possible. Swoopfunding.com. One more question before we head out. If you had to start over today as a founder, knowing everything that you know now, how would you fund your first business?
What a great question. I would definitely try and self-fund for as much of it as I can, and I would use that startup loan again. We used equity, and I think equity is an amazing route, but where you really offer way more and you can carry way more from a negotiating point of view is having traction and having metrics and being able to talk about the levers. And the only way really to do that is get your product live, whether it's a tech product, a physical product, and get customers and gain traction that way. So you really need those proof points. So I want to max out on that equity check when it comes to get the best possible valuation, the best possible terms. So in order to do that, I'm taking more of a self-funded startup loan type route before going down that route.
So in other words, you're banking on yourself. You're like, I'm going to take the bet. I'm going to take it on. I know I can do this if I give it a shot. So nobody else can have control. I'm doing this myself.
Yeah. Happy to welcome people in along the way. But I think that beginning bit, I'm definitely keen to get those proof points in and start getting that early traction.
Perfect. Ciaran, thank you very much for being on the program. Ladies and gentlemen, swoopfunding.com is the website, swoopfunding.com. Make sure you guys check it out. Get all that money you need now, not when you need it later. You get it when you have access to it early on, because later on when you really, really need it, you're probably not going to qualify. So get yourself squared away, swoopfunding.com. Swoopfunding.com. Ciaran, thank you very much for being on the show. Ladies and gentlemen, we'll catch you guys on the next one. Peace. And we're out. It's over.
Thanks so much.
Go home. Is your business in need of marketing? Try starting a podcast, but not just any podcast. Podcast like a pro. We can show you how to take your business from being invisible to becoming a brand people trust. Go to www.businessbros.biz